Welcome to The Explainer. I'm so thrilled you're here today because, well, we're unpacking a massive, fundamental, structural shift happening right now inside your favorite financial apps. If you've been paying any attention to your home screen lately, you've probably noticed something kind of weird. The apps you used to rely on for just one specific task are suddenly looking a whole lot more ambitious. We're witnessing the great rebundling of Fintech, and it's a fascinating evolution that's absolutely going to change how you manage your money.
Okay, let's dive into this. Why are all your finance apps suddenly doing the exact same thing? Think about it. A few years ago, you had one app to buy sneakers on an installment plan, another to hold some crypto, and maybe a third to trade a few stocks. Fast forward to today, buy now, pay later services, crypto platforms, and trading brokerages are all battling it out to become your primary financial hub. They literally want to be the one-stop shop for your wallet. And to understand how they're pulling this off, we're going to look at 3 heavyweight players making radical moves this very week.
Chapter 1. Klarna plays bank, from checkout to checking.
And this brilliantly illustrates the strategy here. We're talking about their new FDIC-insured high-yield savings account, launched here in the US through a partnership with WebBank. The contrast here is just stark. If you park your money in a legacy bank, you're likely getting an absolutely anemic average yield of 0.01%. I mean, it's practically zero. Klarna, on the other hand, is coming out swinging with a 3.78% rate for top-tier members on balances up to $50,000. They're offering a highly aggressive premium just to get your cash out of that traditional checking account and into their ecosystem.
Klarna's CEO Sebastian Siemiatkowski really didn't mince words about this strategy either. He bluntly stated, the average American earns less than 0.5% on their savings, not because better options don't exist, but because their bank hasn't had to compete. It's a remarkably direct shot at traditional banking stagnation. He's basically making the case that legacy institutions have just coasted on zero-interest deposits for a decade, and Klarna is stepping in to force that competition.
And make no mistake, this isn't some experimental cold start for them. The playbook is already completely proven. Klarna safely holds an astounding $12.3 billion in consumer deposits across 11 different European markets. So they know exactly how to manage savings at scale. They're just bringing that proven, battle-tested infrastructure across the Atlantic to disrupt the American market. You know, ever since Klarna's wild IPO back in September 2025, where the stock debuted at $40 and just went on an absolute roller coaster ride through 2026, investors have been scratching their heads wondering, what exactly is this company? Are they a buy now, pay later service? Are they a neobank? Well, this launch makes the neobank thesis pretty hard to ignore. Spending, saving, and paying all in one app. It's the exact same all-in-one playbook that companies like SoFi have so successfully pitched to Wall Street. So yeah, Klarna has officially stopped being just a checkout button and started being your checking account.
Which brings us to our second case study. Coinbase redefines credit. Crypto as a credit score.
So Coinbase just partnered with Cardless to unveil a new credit card specifically targeted at users that traditional banks consistently, well, ignore. They're creating a bridge between your digital assets and real-world purchasing power by relying on what's known as crypto-collateralized lending. Now, I know that sounds like super heavy financial jargon, but the concept is actually incredibly straightforward. Instead of relying on a traditional credit history to secure a line of credit, you use your digital assets, specifically stablecoins held on Coinbase, as collateral. Your crypto essentially acts as your security deposit. It completely bypasses the traditional FICO score system, allowing you to spend like a normal human using a standard credit line.
To really understand why this matters, you have to look at the sheer scale of the problem in the traditional financial system. We are talking about roughly 45 million Americans who are either completely credit invisible or trapped with subprime scores. That is an enormous addressable market of people who are essentially shut out of basic financial leverage. And as crypto adoption grows, a much larger slice of those 45 million people hold on-chain assets that, until right now, couldn't actually help them buy groceries or rent a car.
When asked about the card, Cardless co-founder Michael Spellfogel described their target audience as people beginning their journeys in accumulating wealth, which, let's be honest, is just a very nice, highly diplomatic way of saying their FICO score isn't cooperating right now. But it's true, right? Using verified on-chain assets as collateral instead of a somewhat arbitrary credit history is exactly the kind of logical financial innovation that just makes perfect sense in retrospect.
Coinbase's stock has definitely had a confusing 2026, violently swinging anywhere between $139 and $444 over the last year. Wall Street keeps shrugging because they just don't know how to value them. Are they a pure crypto exchange, a stablecoin infrastructure play? But when you step back and look at this ecosystem shift, we're seeing a major business evolution. Turning a crypto portfolio into an actual credit application transforms Coinbase from a simple trading platform into a genuine credit issuer. And that is a huge leap forward.
Finally, let's look at our third major shift. Robinhood becomes the house, owning the infrastructure.
Robinhood has always been the king of retail stock trading, but recently they've pushed heavily into prediction markets, and they are quietly making a massive strategic pivot. They're breaking ties with their longtime partner Kalshi to route these contracts through their very own CFTC-licensed exchange called Rothera, built in partnership with Susquehanna. Now, what's really interesting about this data is how clearly it shows a rapid migration. Notice how in March 2026, Robinhood users accounted for a whopping 25% of Kalshi's total trading volume. But jump to April, that share had already dropped to 20%. Robinhood is systematically and intentionally siphoning their enormous flow of trades away from their partner's platform and directing it straight into their own proprietary ecosystem.
And the timing of this? It's incredibly strategic. Rothera is about to face its ultimate stress test, the World Cup, kicking off on June 11th. With 104 matches spanning across the US, Canada, and Mexico, the volume of prediction market trading is going to be absolutely astronomical. Robinhood is ensuring that their new in-house infrastructure is up and running just in time to capture the absolute frenzy of the world's biggest sporting event.
And honestly, the volume we're talking about here is almost hard to comprehend. Robinhood has already traded over 16 billion event contracts year-to-date in 2026 alone. 16 billion! Every single one of those contracts that runs through Rothera instead of Kalshi represents a trade where Robinhood doesn't have to share a single cent of the fees with anyone else.
Robinhood's CFO, Shiv Verma, explained the economics behind this perfectly with a really relatable analogy. He said, it's like paying rent for years and then buying the building. And he's absolutely right. When you outsource your exchange, you pay a toll on every single trade. But when you own the exchange, you own the margin. Robinhood isn't just a brokerage matching buyers and sellers anymore. They are becoming the house. And as we all know, the house always wins.
Which brings us to the grand finale, the rebundling of fintech, the evolution of the business model.
A decade ago, the initial era of fintech was all about unbundling the traditional bank. Startups picked off one specific feature, like stock trading or international transfers or installment payments, and did it way better than the legacy banks. But now, that fragmentation phase is totally over. These specialized apps are growing up and rebuilding the bank from scratch, entirely within their own borders. So the crucial point is this. We've looked at three distinct companies making three seemingly distinct moves, but they all point to the exact same macroeconomic trend. Klarna is leveraging BNPL loyalty to become your high-yield bank. Coinbase is using your crypto assets to become your credit score. Robinhood is bringing prediction markets in-house to become the core infrastructure. They are all chasing higher margins and far deeper, stickier control over their users' financial lives.
The walls between saving, spending, trading, and borrowing are completely collapsing. These platforms don't just want a piece of your financial life anymore, they want the whole shebang. Which leaves us with one incredibly important question to ponder. As these single-feature apps become comprehensive, one-stop financial shops, who will ultimately win the battle for your wallet? Take a look at the apps on your phone right now and ask yourself, who are you really going to trust to hold all the keys? Thank you so much for joining me on this explainer. I hope it helps you navigate the rapidly shifting landscape of your money. Until next time, stay focused and stay curious.